Hello and welcome to The Market right here on 18 Now with me, Asha Fariri, Nikunj Dalmia, Avandabash in the studios. And what a week it has been, a historic one at that. You could rub your eyes on disbelief or say that you predicted so. But we have had the best week in about almost 3 years' time. And for a sixth week, actually, we've managed to see an advance coming in. But yeah, last week, it was something magical.
It was something magical, and I don't think the rub-off effect of magic actually fades away. I mean, when magic happens, you actually get enamored for some period of time. And that is what I think will happen in terms of the market setting. So while the percentage gain may not be that large, but the market positioning, I guess, is very clear, which is that you want to stay on the course. You don't want to wait for big declines. The market will not give you a big decline. And market, in a sense, is now suddenly getting a big leader, which in a sense was not on everyone's radar, and that's banking for you. If one really looks at the market setting for the week gone by, big gains for banks, and that in a sense would be the talking point. And the market positioning in large cap stocks is such that the total combination retail versus FI, which is what I always look at to understand the market. The FI long is 57% and the retail long is 44%, which means that even though, yes, it was a monster week, nothing short of magical, but the market positioning in large cap stock is still not very extended, which means that both technically, this market is not very overbought. The direction of the market, it is headed higher. Liquidity, I think, is very clear that it is coming back. And in terms of momentum, I think it is evident that it is on the right side. Since we've put a very big week behind us, the market may easily consolidate. That would be healthy. But frankly, I think in terms of a trend, we are headed higher, as simple as that.
Yeah, looking at the long short positioning as well, it seems like there's further headroom and significant headroom from these levels.
Yeah, so if you're at an all-time high, you would say there has to be an excitement, there has to be participation, there has to be euphoria, and there has to be, technically stocks have to be overbought. That is not the positioning. I mean, the bank Nifty just about cut out loose. The positioning in the FI long is only 57, retail is 44. So even last week, it was more short covering and less of fresh buying. And these are typical signs that the turn in large cap stocks are just about started. We are not at the end of the rally. So we are at the beginning of what could be called as a momentum stroke liquidity driven rally in large cap stocks. But the interesting bit, Aisha, here is that, okay, now what do we do? I mean, is it that good old debate of large cap versus small cap? And I think that is a point which we really need to ponder over. Last week, Nifty appreciated by 3.5%. But within that same time frame, the small cap index appreciated by just 1%. And we've seen always the reverse. So for me, this is a telltale sign of which way you should look, which index I think needs more attention. See, it's sequenced so nicely. Nifty is up 3.5, bank Nifty of 5.5, small cap 1 and mid cap 2.5. The most underperforming or the biggest underperforming one is bank Nifty, which in a sense has really hit out of the park. Yeah. So the market would be centered around banks because FIs are coming back. Market action would be centered around heavyweights and large cap stocks. I think small cap stocks should take it easy, and it will not hurt you if you rotate 15 to even 20% of your capital back from small and mid cap stocks to large cap stocks. I continue to maintain that view.
Yep, that's exactly how the script played out, at least for the markets in the last week, as you can see on your screens. A quick check-in on the global markets as well, and you had most of the indices on Friday's trading session. On Wall Street, that rose. It was the S&P 500 that actually hit a new high on the back of the November jobs report that came in. This morning, though, it's a little bit mixed when it comes to the Asian screen. China is looking a little bit tempered, largely on the deflationary pressures. But for the rest of Asia, it's a bit of a mixed bag. And back home, we'll be looking at a lot of events this week, critical to map out what happens when it comes to the FOMC meet. You've got the CPI data as well. That's back home, as well as a lot of IPO action, DOMS, India Shelter, Inox India, a lot of these IPOs in action this week, Nikunj.
So, Avan, look, IPO action, there is nothing which could be called as very large or very different.
I guess FOMC maybe takes
So
center
FOMC would be
stage.
important because this in a sense would be the last FOMC meeting, and this could also be curtains down to what you would get from global central bankers. And then next 15 days post the FOMC meeting, global markets will have to fend themselves. But given the context of where the bond yields have moved from 5% to 4.2% or 5.1 becoming 4.1, this FOMC meeting in a sense could be crucial to set the tone for the last 15 days and initial start for 2024. So from a market standpoint, given last week we did get a fillip into flows because of the crack in bond yield, the FOMC meeting in a sense would be important per se. I don't think markets are worried. I don't think markets are anxious, but markets would definitely like to get a reassurance that somewhere inflation or indirect hint that inflation is showing signs of cooling off or inflation is showing signs of peaking out. So I think that in a sense would be important. Barring that, there is no calendar action. I don't think CPI data is relevant from a market standpoint. IPO action, I mean, there is nothing large in terms of a Magnus Opus IPO which we can talk about. So it's just going to be by and large more like a routine week for everything else.
Routine, except for the fact, Nikunj, that ET Now has bagged 3 awards at the NT Awards 2023. So from promo campaign of a news channel, which was our budget promo, to the promo for the channel. And congratulations, Nikunj, we have the best business news anchor sitting in our midst.
Thank you very much. It's
Where's the party?
It's very humbling, and you just want to thank everybody for this.
Yeah, because everyone has really put in a lot for all of these promos and everything that you see on the screen.
You know what we show on screen, there is a lot behind screen.
Exactly.
And that behind the scene, I think, is far more important. Like when you look at a good building, there is always a base building which happens, and I think that is what happens at the ET Now office. What you see on air, I guess, are anchors, but what is behind is our entire production team, our entire promo team, and it's a very humbling and a very big honor for all of us to really accept this award on behalf of everyone. So thank you very much, and thank you for your wishes, and thank you for your love.
Okay, and ET Now Swadesh as well actually won big, so a big congratulations there, because Ajay Sharma as well won the business news anchor, and then we won for the news program for business as well. So big thanks to all of our viewers and everyone behind the scenes, but let's move on because we've got some special programming and some great interactions lined up. In fact, on Khane Pe Charcha's episode, none other than Hansa Yogendra. Take a look at a sneak peek.
It gives me an honor to invite Hansa Ma on this episode of Khane Pe Charcha. Namaskar.
Namaskar, namaskar. It's lovely to be with you.
They always say, Hansa Ma, mind is the thought you have and your body is the food you eat.
Right?
So yoga ke
As
hisab
the
se-
food, so the mind.
Exactly.
As the mind, so the man.
सब हम स्टॉक मार्केट्स में हमेशा बोलते हैं कि बुल मार्केट इज रिलैक्सिंग, सो सांस लो. बेयर मार्केट इज ऑलवेज टेंशन, सांस छोड़ो. बुल मार्केट, बाय अ गुड स्टॉक,
Hold it.
एंड व्हेन इट रीचेस फेयर वैल्यू,
Leave it.
sell it.
Correct. You
बुल
are
एंड बेयर
great.
योगा.
Lots of learning, and Nikunj, is that the next phase? Yogi Nikunj?
No, not yogi. I mean, see, okay, bit of a spirituality and philosophy here. I mean, just think about it. What I learned after this interaction was that you always think that yoga is twisting and turning. Now, that's the technology of yoga, which is that
Basically breath work.
that's the technology. But then there is also a philosophy. So philosophy and technology, they both have to come together. And at what alignment do you do an asana? It is something which can be corrected. But that's the technology part. But then there's a huge philosophy part, and there's just so many versions within yoga. It really depends on what you want to pick up. But it's really all about identifying whom you are and what is the purpose of life. So that's a slightly deeper philosophy. I've just started my journey on that path. So
Finding
maybe
your ikigai.
no, it's good to connect with
Yeah, of course.
with
You have
you
to
know
have a
what you have
purpose and
exactly.
more importantly, know it.
It's so much about nature. Just think about it. I mean, what the big yoga asanas are, cobra asana, you want to call it. It's really about keeping your back, but it's connected with what the cobra is. So it's just a different world, and it's a beautiful world. And I would encourage everybody really to walk on that path.
Okay. That's that. Let's talk about the path of markets. And Monday morning, who better than Kunal Naresh to kickstart that discussion? Kunal, hi morning. Historical week and then some consolidation. What's in store for us this week?
Yeah, good morning. So I would expect more or less similar to the last couple of days what we've seen in the indices, 100 to 100 point range for the Nifty. I think 21,000 odd is now becoming a good pivot for the index. We've seen some good shifting of option positions for the indices at those levels, and I believe that this shifting would probably continue for some more time. We could probably be looking at a fresher breakout for the Bank Nifty. So I think what's happened on Friday was Bank Nifty moving up closer to 47,500 mark rather than sticking to that 47,000 levels, which means possibility of Bank Nifty moving to the next psychological mark, which is 47,500 and higher, would be a lot more higher probability as compared to the Nifty moving up higher. So I believe indices would consolidate, but Bank Nifty would have that slight upper edge in terms of the movement on the upside.
All right, upper edge. Let's find out what Naresh makes of the trade setup, because it was a fabulous week gone by, Naresh, given the fact that we did see the frontline index advancing for 6 straight weeks on the trot. It's the longest buying streak that we've seen in 3 years. What's this indicative of?
So the indication is the speed which has happened in the last few sessions, which clearly tells you it's a breakout move. We've broken out with a gap on the Nifty. We've broken out on the Nifty 50 in US dollar terms. So there should be a lot of flows which should relatively get better. And Bank Nifty, after a long time, has started making an outperformance. And a lot of stocks in the Bank Nifty have started making new 52-week highs and all-time highs. So you have a ICICI Bank, Axis Bank and SBI closer to 2% away from an all-time high. So clearly Bank Nifty should take leadership in the near term. Expect the larger names to surprise on the upside. So like SBI, ICICI Bank for a breakout move and Axis to continue. So overall, the bias is positive. Remains a buy on dips if we get a dip. Overall, the next levels to watch out would be 21,200 and 47,500.
Okay, keep those levels in mind from Naresh, but let's find out those stock-specific calls as well. Kunal, what's on your radar?
So I'm sticking with large cap names. So going with TCS is the first stock which I would recommend as a buy. Now revising the targets higher to 3,700. Very good breakout for the stock on the short-term basis, as well as swing confirmations for the stock on the daily charts. So 3,700 as a target, stop loss at 3,600. And Kotak Bank is the other name which is completing an inverted head and shoulder pattern above 1,805, 1,810 mark. The stock has closed above those levels convincingly on a weekly basis. So would a buy with a target of 1,885, stop loss at 1,790.
Right. Naresh, is your tilt as well towards large caps?
Yeah, so it's more a large cap and a mid cap. So first is a buy on ICICI Bank. Now clearly the stock has shown a lot of outperformance in the last few sessions and is now on the verge of a breakout into new all-time highs. And 1,000 was a major resistance for the stock, and we are above that. So expecting a short-term momentum towards 1,100, stop loss at 970. Second is a buy on LTI Mindtree, which has been a relative underperformer in the mid-cap IT space. The stock has broken out in the last few sessions. Expect this momentum to continue towards 6,000, stop loss at 5,650.
There you have it. That's a strategy that our chartists are adopting this morning. Hope you've taken note. Let's find out which stocks are on the radar today. We've got Anisha here to discuss that in our studios. Anisha, let's start off with GMR Infra. Interesting with that block deal with GQG Partners buying some stake. Tell us more.
Well, yeah, that's the move that we saw on the stock price on Friday as well, right? It surged in double digits, so a massive gain of 12% thereabouts. Finally, we do know, and the confirmation is out, that GQG Partners has picked up over 4% stake in the company. So that's something which is coming as a big fillip for the stock. Separately, there are a couple of other news pieces as well. The company's managed to raise around 3,200 crore rupees for its Bhogapuram International Airport, which is in Visakhapatnam. So that is also something which is a bit of a positive news. And when it comes to the Goa operations, there as well for the Mopa Airport, there has been a revision of tariffs. So that also is something which is incrementally positive for the earnings. Over the last couple of years, we have seen a complete turnaround of the company. They've managed to reduce their debt in a very sizable fashion. They've of course taken the value unlocking wherever possible and the monetization wherever possible. And now the balance sheet is looking very, very lean. In fact, going forward, they have rapid expansion programs as well as something about the Delhi duty shop which they're looking at value unlocking as well. So Nikunj, a lot has happened, and we keep on talking about the traffic at the airport, right? The number of footfalls, and that should just mean good news for the company now.
See, to be very frank, GQG has earned a reputation for itself after this entire investment in Adani, and pretty much the same thesis that you buy infra companies, which in a sense have a 15 to 20 year kind of a clear, moat around them. So airports are growing. The Delhi airport is the largest in India. We pretty much know that the footfall there are likely to grow. Tatas are making that as an hub. So in terms of the big picture argument, you're right up there in terms of a real, asset which in a sense could be more, which will grow and which in a sense will be very unique in terms of an infrastructure play. For GMR, look, they've had the issues in terms of debt, and now that fresh capital investments is coming in, can they really grow? And markets typically are in that frame of the mind where they don't think infra is bad. As long as the risk is manageable and the business is growing, and if the sector is growing and if the company is coming out of what could be called as a debt crunch, markets in a sense are okay with that. There was a time when you got debt, markets don't like you. Now the phase is that manageable debt with high cash flow and with visibility of next 10 to 15 years, well, markets like that. So I guess GMR Infra is really falling in that club, so to speak. I've not looked, it's difficult to look at calculations because there is no large peer for GMR Infra, but given that they're getting capital infusion back into the balance sheet, that means that in the near term, they can actually grow, and they can grow by not increasing debt, but by raising the equity component.
Okay, and the other stock in focus, Max Health. What's the news flow here, Anisha?
They've actually acquired one of the small hospitals in Lucknow, so that comes as a positive news. It's a 550-bed hospital that they're acquiring from Sahara Group in Lucknow itself. Now, this is, of course, for the 100% acquisition. The deal has been done at an enterprise value of 940 crore rupees. The current operational bed capacity is around 250 beds, and the annual run rate in terms of revenue is around 200 odd crores. So this comes as a positive news for the company. The transaction is expected to be completed within 2 to 3 months. This will help them to expand into tier 2, tier 3 facility as well as the fact that the company had a rapid expansion program. They had talked about adding 4,000 additional beds over the course of medium term. So this is a step in that direction, and in fact 2,600 beds are likely to be added in 4 years itself. JP Morgan says that the acquisition has been done at a consideration of 4.7 times EV to sales, which is in line with what the industry average has been. They maintain a neutral stance with a target price of 620, but overall another positive news coming in, and consolidation really continues in the healthcare space.
See, let's understand the sector per se. The sector per se has seen a lot of consolidation and a lot of PE investors, which in a sense are really looking at changing the dynamics. So the Indian healthcare sector up until now was a promoter-driven healthcare sector, and now suddenly it is a sector which is now driven by PE investors, with the exception of, let's say, Apollo, like Fortis. I would say there are global and there are PE investors. Ditto for Max, ditto for a lot of other hospital chains now, where the PE investors in a sense are very active. Now for Max per se, well, guess what? They are entering into Uttar Pradesh and they are entering into UP. That state is growing both in terms of per capita spend towards healthcare, also in terms of size. While this may not be a very large market moving news per se, I think that in this case there was a asset which was available after the repositioning of the Sahara Group, and Max in a sense must have acquired it after competitive bidding. Now for Max, this is a decent acquisition. It's just going to give them their whole spread outside Delhi and north, and the fact that they're moving into Uttar Pradesh, I guess, is a clear example that is one space, that is one state where now technically you're actually seeing a very large amount of uptick in terms of per capita spend, also in terms of availability, in terms of where healthcare needs are going to be going higher. We always tend to think, Aisha, that okay, the high spenders are always with big cities. They don't look outside 6 metros. But the data what we're getting from, let's say, Uttar Pradesh or even Lucknow and some
all of Gujarat.
And all of Gujarat, it just tells you that India is changing. So the spirit of this acquisition from Max, look, Sahara is having a change in terms of what the group focus is. So then asset was available, they bid for it. But they're moving into Lucknow, even Medanta had moved and they are moving. It just tells you that which way the real delta in terms of healthcare is going to be coming in.
Yeah, absolutely. So let's keep both those stocks on our radars. Anisha, thanks for flagging off those. But we'll take a very quick break. When we come back, we'll discuss all the other stocks in focus as well. Why you need to keep a DRL, UBL, as well as Subros on your radar this morning.
Welcome back. The GIFT Nifty implied open is down by about 0.2%, and it's been a big standover from the Asian markets this morning. But let's find out a little bit more about the stocks that will be in news today. And as the December 21st deadline for the Zee-Sony merger is only getting closer, the leadership struggle continues. ET now has learned from sources that Zee has still not agreed on giving the MD and CEO post to Sony India's representative. Let's get in a little bit more. We've got Ankur Mishra who joins in with the details. Ankur?
Yes, both the parties are trying to resolve the matter, as we understand that the meeting which was held last week did not yield any result, and Puneet Goenka continues to press for his name as MD and CEO of the merged entity because he believes that agreement was based on that fact. However, if you see the Sony stance, that continues that it should be NP Singh who can be MD and CEO of the merged entity, because they believe that since SEBI investigation is currently underway against Mr. Goenka, therefore it should not have any problem later on the merged entity. So that problem needs to be solved before the deadline, because the merger needs to get completed by 21st of December, which was the agreement which was signed between the two parties. And as far as the process is concerned, they need to move to INB Ministry for filing, as that approval has to be obtained before moving to finally ROC for getting that merger completed. So all these processes needs to be completed within this 2 weeks deadline, and before that we understand that the meeting which was held last week remained inconclusive. Apart from that, there is also a petition which was filed by IDBI Bank as well as Axis Finance, which continues in NCLAT, and that was against the approval which was given by NCLT on Zee and Sony merger.
Okay, and on to another ET Now exclusive, and sources tell your channel that the Securities Exchange Board of India, or SEBI, may reduce the minimum ticket size for SIPs to as low as 250 rupees per month. Ankur is back with us with more details on that.
Yes, market regulator SEBI is said to be working with mutual fund industry for rupees 250 SIP. Yes, you heard it right. Current minimum limit is 500 for SIP, that is systematic investment plan, which you can invest monthly or quarterly. Now that limit is considered to be reduced to 250. It could be a actual sachet movement as per the sources we spoke to. However, let me also make that clear that it is at a discussion stage with regulator. The regulator is just assessing the impact of reducing the SIP's minimum limit. What will be the implication? That study is currently underway by the regulator, and only after that, as a process, there will be draft guidelines, and finally the guidelines will be released by the regulator. But for now, the idea of bringing rupees 250 SIP is on the table. It is considered with the mutual fund industry, and remember, as far as the latest data released by AMFI, the AUM of mutual fund industry has touched 50,000 crore, and if you talk about SIP, that is also crossed 17,000 crore.
Thanks very much for those details. Let's move on then. And United Breweries in the spotlight. They conducted their management meet. We've got Ashesha who joins in with the key takeaways. Ashesha?
Nuvama met with the management of United Breweries, and on the back of that they've come out with a detailed report. First up, they've spoken about their market share expansion plans, where they say that they are focusing on winning back market share. Currently, their all-India market share stands at about 49%, and as far as the premium category is concerned, company's market share stands at a little less than 20%. But the company said that they've achieved market share expansion in the past few quarters, especially in the states of Rajasthan, Uttar Pradesh and Odisha. As far as gross margins are concerned, they say worst of barley is now behind, and that glass costs have also moderated in the past few quarters, and that perhaps margins could expand from here on. As far as companies and management's focus is concerned, they say that they aim to increase customer engagement and increase focus on premiumized portfolio. Remember, this portfolio contributes about 15% of their total revenues currently, and they aim to increase it further as we move on. As far as pricing is concerned, they say that they are working with the state governments to make favorable policies for beer, and they also say that they see attractive industry opportunity given that beer penetration in urban India is currently less than 20%. So good opportunity, reducing raw material costs, which could perhaps increase margins going forward. And the fact that the company is focusing on market share expansion is why Nuvama is bullish on this counter.
Okay, that's that on UBL, but Lloyd's Metals as well is going to be in focus, Ashesha. Why is that?
Well, yes, so the management of Lloyd's Metals has gone ahead and approved a total capex of about 25,860 crores. The company also said that this will be undertaken over the next 6 to 7 years. Capex will be funded internally, and that not substantial debt will be undertaken in order to fund this capex. Let's also talk about the breakup of this capex, where the company said that the total capex outlay stands at about 26,000 odd crores, out of which 16,000 crores capex will be utilized for setting up a 3 million ton per annum integrated steel plant. Apart from this, 5,000 crore capex will be utilized for additional 45 MTPA beneficial plant which will be set up by the company, 4,500 crores for a pellet plant in Gadchiroli. So several capex plans which total to about 26,000 odd crores. Apart from this, the company has also received a mineral resource report which says that the company has total geological resource of about 863 million tons, out of which 157 million tons is of iron ore, and the balance 706 million tons is for BHQ. Now, Aquarius has come out with a report on the back of this, where they say that the company will be sufficiently positioned to fund the entire capex through internal accruals, and that the management will not have to take additional substantial debt in order to fund this capex. So yes, important capex that has come in from the management, not a counter that we frequently talk about, but that's significant expansion plans, and hence the stock will be in focus today.
Let's welcome on board then Sanjeev Hussain, who's joining in on the show. And Sanjeev, going by last week's data, the case is being made stronger that now maybe more allocation to large caps can be preferred given the muted move that we've witnessed within the broader universe. Your views?
Yeah, good morning, Awan. Well, that seems to be the key. And when large cap, when foreign money returns in the ETF flow or in direct investment, it will always chase the large caps. We've had a large underperformance as far as Bank Nifty or the heavyweights, particularly HDFC and Reliance. And I think there is a catch-up trade there. So rightly so, I think the Nifty or the Bank Nifty will be more constituent in an upside, and mid caps could take a small breather, but the market breadth is telling you something else. So if there is money on the table as we discount these events, I still think the mid caps will be market performers, if not outperformers. So yes, large cap banks are looking extremely good, and a select stocks in the PSU basket also deserve attention.
Right. Sanjeev, hi, morning. While of course it's a case-by-case story within individual stocks, but for those who are in the money, and that's pretty much everyone when it comes to mid and small caps, would you say stay put or book profits?
Yeah, good morning. So Aisha, a few clients called me a few days back, and they were thanking me for the move in GMR from 35 to 60. And then they said 2 days back that they booked profits and they lost out on the last 15%. So I don't know the last 15% when it comes. GMR jumped 15% in a day. And I think that the last mile recovery is still there. So stay put, book a bit of profit, get into large caps. There is nothing called sitting on cash because this is a bull market. You will have enough opportunities maybe coming your way, but you have to see where you can deploy your cash. So I still think like select pockets are going to be outperforming. But in the broader universe, I would still put money on the large caps because I would be having more assurance on earnings, on price multiples, and safety of any correction. I think in the next correction, mid caps will have a faster leg than the large caps.
I will come to large cap, Sanjeev, but have to discuss GMR Airports first. And given their newest investment by GQG, which is famous to catch stocks and companies at their bottommost, you think it's still a buy even after the jump it has had last week?
So Aisha used to tell everyone, look at the rush at airports. आप देखेंगे कि आपको you don't have place to stand, and people used to take that in a lighter vein. Well, it's up and running at 70. Also, if you see AeroCity is booked to the hilt, there are no rooms available. Hotels and weddings go sink, and the airline business is doing the best it is ever. You've seen Indigo hit all-time highs and so on. So I still think there is juice in the upside, but a large part of it may be now in because these type of large players, when they come, they do make a top for the time being. You've seen a similar case in IDFC First and so on. But let me tell you, GQG is laughing his way to the bank because he had the courage to buy, Adani stocks when there was no buyer. And that's why when he's laughing his way to the bank, the risk taking will be even more. So you do your own gauge on your risk taking capacity. But I still think GMR can, maybe scale 85 over a period of time. However, it's a caveat that if you have those stocks, please book your some profit also, because these are volatile stocks of infrastructure dependent on a lot of moves. And I think that, this last move has been caught everyone by surprise.
Yeah, absolutely has, right? That 12% stake buy, almost a 12% surge in the stock on Friday alone. But Kunal, the other part in the entire aviation boom is Interglobe Aviation. What is your reading on the charts for this one?
Yeah, so I think it's been a stock which is I think now in the last 2 months or so, I think is now come back into a breakout of sorts, because earlier the stock was struggling a bit. I think from 2,700, 750 mark in the mid of August, start of September. I think from there the stock struggled, corrected towards I think 200, 250 odd points towards 2,500 mark or slightly below. But I think now it's found its mojo back. It's managed to break past about this 2,700, 2,750 mark. The last 2 weeks of volumes also for Interglobe Aviation have been quite attractive. The stock has opened with a gap up, not filled those gaps. So I think all of that augurs very well for the stock price, and the tendency of the stock to get into that odd phase of consolidation and then all of a sudden get into a breakout with gap formations is typically a very good sign. So I think it looks like a bullish setup for Interglobe Aviation. I think 2750 could be a good support for the stock over the near term, and keeping that as a stop loss, traders can hold on to their longs.
All right, some fresh brokerage notes this morning, and you've got the steel sector that's in the spotlight on Morgan Stanley's latest report. They've got an equal weight and underweight rating for the most part on most of these names, but they believe that the domestic demand is going to be strong in next year and that spreads will remain range bound. Sanjay, from a stock market perspective, what's the view on the likes of a JSW, Tata Steel, JSPL, etc.?
Correct. And Aman, I think this is now going to be an outperforming sector since we realize that the dollar weakness is here to stay. And I see no recovery. I mean, I would say the dollar is going to double digits over a period of time, which means, combined effect of China comeback and steel production at a high, plus the infrastructure story in India means steel is going to be a very, very key conduit. In fact, all ferrous, non-ferrous metals are looking very good. So buy a basket of stocks which include JSW Steel, Jindal, Tata Steel, not to mention that SAIL has gone into 3 figures and that could head towards 125. And please add Hindal as also a play over there, because I think Novelis is performing brilliantly. So a basket of stocks will do well. We, as a disclosure, have Jindal Steel and JSW in our portfolio.
Why Jindal Steel and JSW? Why not Tata Steel or SAIL?
So, Nikunj, we thought that these are better outperformers as far as numbers go, and they were showing you more traction on their margins. JSW, as you know, is the best integrated play in the country, and Jindal has reduced debt substantially. So return on equity became very, very important. I am not doubting Tata Steel or SAIL, but as a preferred choice, we thought these are two stocks or two corporates which can be outperformers.
Sure. Sanjeev, you're now tactically moving higher allocation and fresh buys towards large caps. Give us three other names other than what we've talked about where you think one can buy still.
That's $1 million question, but I still think Ultratech is headed to 11,000. And I would say that, your whole gamut of gas authority, the city gas distribution companies, I'm very bullish on MGL, on Gujarat Gas. These are two names which we like. We like GAIL in that space. And not to forget that in this commodity space, Hindalco is one stock which has already scaled new highs. I think the ferrous, non-ferrous business, both for them on the on the copper smelting part, where the treatment charges, refining charges may be at the highest, and plus Novelis has been an outperformer. So these are 5-6 names which we think can be outperformers.
Okay. Could cement make a comeback, Naresh? I mean, it's one space where we've seldom discussed outperformers. The last couple of months has been all about defense, PSUs, power. What about cement?
So we've started seeing momentum breakouts in a lot of cement names over the last few sessions. So you have an Ultratech which has broken out into new all-time highs. You have a Shree Cement which has broken out. You have a JK Lakshmi Cement which has broken out. Even a name like India Cements is closer to a 2-year high. So clearly the momentum is there. So if you look at an India Cement, it used to be 250, 260 in 2021, has come back to those levels. So one can have a basket of names out here. So smaller names have also started giving a breakout. So something like a Heidelberg Cement give a breakout in the last few sessions. So yes, the cement momentum is there. The only case is this as a sector does not go into a wild move. It's a slow and steady move generally. So I would have a buy on dips on this sector as such, because some of the names have moved up 10-15% in the last 1 week. So a buy on dips and slowly accumulate.
Okay. Where are some of the ranked mid-cap stocks headed, Kunal? JP, Suzlon. Last week they did not participate at all.
Yeah, so Nikunj, you were discussing this point, I think last week or so, that the mid caps are bound to get into a phase of consolidation and the large caps would take charge because the risk reward is more tilted towards rather in the favor of large cap names. And we've seen exactly those patterns shaping up for many mid cap stocks, and I'm talking of not just mid caps but the small cap 2-digit stocks which have been moving up significantly higher, I think, the month of September, October so far. So I think I would probably believe the likes of Suzlon, JP Associates, Vodafone Idea, I think these stocks have gone through a time-wise correction. In fact, in the last 2 weeks, if you look at the relative price performance, these stocks have either been absolutely sideways or just gone through a corrective phase, I think of 5%, 10% odd for themselves respectively. So I would believe that this pattern would likely continue for some more time unless the large caps, they come back into a zone where they may get into a overbought zone on the short-term charts and they may consolidate. That's where I would believe that the mid caps could pick up pace.
Right. Okay, that's the take coming in on some of these names. Lots of other buzzing mid caps and small caps, which are going to be in focus, as was the case last week too. What with the continuing move on NIFTY, PFC, or for that matter, an RBL Bank. But today, there's going to be focus on Cyient. They held a recent analyst day meet. The management has given a revenue guidance of 10 to 20% over the next 3 to 5 years. Let me take it across to Anisha and get in more details.
Oh, well, yes, the analyst meet was held, and of course, the analysts have come back quite positive. Over the next 3 to 5 years, they're expecting a 10 to 20% growth, even if they have maintained their FY24 guidance in terms of revenue. At least in terms of margin, there seems to have been an uptick in guidance because they're now talking about 150 to 250 basis point in terms of margin improvement versus the earlier 100 to 200 basis point. So that's a good news coming in. The management was also quite candid about talking of how M&As are likely to play a big part in their growth going forward. They're looking at capability-driven M&A acquisitions as well. So that's something to watch out for. Separately, in terms of the other details, the management is aspiring to take the company onto a strong, sustainable, profitable growth path, and they're looking at growing a balanced portfolio. delivering intelligent and tech solutions. Having said all of that, the brokerages are a bit circumspect before increasing the target price, because remember, the stock has already run up 160% this year. The value unlocking through DLM has already happened. So for instance, you have Nuvama, which has maintained the target price at 1920 and retained the hold call just because the stock has run up quite substantially.
Anisha, we'll leave it at that. That's the latest coming in on the likes of Cyient. But Z, that's been the other one which has been in focus. We already told you about all the developments which are currently at play at Z. But in the meantime, whole host of other stocks also which have been quite the momentum ones. We of course discussed GMR Infra, but there was an RBL Bank as well which held higher by about 4.5%. Sanjeev, you've talked about your preference towards large cap banks, but within the smaller ones list, would RBL feature in there?
Yes, 100%. And I came on your show and I said if there was one mid cap bank I'd buy in this correction when the RBI move came, it would be RBL. We own it in our portfolio. You know the RBL has no stake more than 1.5%, and Mahindra comes and buys 4%. This bank is going to be an outperformer on the sheer weight that there is no strategic ownership now. And Mahindra, whatever they may say, there is a strategic interest of upping their stake in financials, and the best conduit could be a bank which is actually no stake over there. RBL's earnings have improved. The new chairmanship of the SBI person has been exceptionally well, and I think the present management, then their focus on the NBFC side has been huge. Their finance arm has opened more outlets in the last year than in the last 5 years, which is telling us that their credit expansion or their book and NIMs will be very, very strong. So I would say this is headed for 350. As a disclosure, this is in both my personal portfolio and in our client portfolio.
A lot of news flow around the sugar sector last week, Sanjeev, and clearly the government, pouring cold water on sugar mills' ethanol dreams. At least that seems to be the understanding as of now. What do you do now? Book out, or would you say buy into the decline? Because this seems like a temporary move. Ethanol is not going anywhere, and sugar stocks will be beneficiaries.
Correct. So, Aisha, the issue is that right now there is a lot on the table, and you can choose between other things which have more transparency, more earning visibility, and where there is more, space on the upside. Sugar has been a big outperformer, and I know for a certainty that the molasses or the baggies part of sugar, which is left out of the blending, is being lapped up for more, industrial use and so on. So, in the end, Balrampur is one of the biggest blue chips, and it will find some buying succors. But in the meantime, people would prefer to get into large cap banks and other stocks which have not done much. So there is a rotation going on. I would still say if you have the sugar stock, stay put and buy only when the consolidation takes an end. That is why you will, or do a systematic SIP and try and add some of the big names, particularly EID Parry, DCM Shriram and Balrampur Chini.
Okay, fair enough. Thanks very much, Sanjeev, for sharing with us your thoughts and giving us views on your recommendations. Time to welcome on board Sandeep Sabharwal as well, who joins in on the show. Sandeep, why don't we start off then by talking about the entire sugar basket? Given the kind of news flow that we've seen, what is your assessment as to how things are likely to pan out for individual stocks within the space?
Sugar was a good story building up because of the fact that global sugar prices were on a boil, and then domestic sugar prices had also moved up, and on top of that we had the ethanol story. Now with this one action, the government has actually spoiled the entire space, because if you ban ethanol production, then sugar production goes up. If sugar production goes up, sugar prices come down. And a lot of companies have spent a huge amount of money in setting up these plants for manufacturing of ethanol. So what happens to them? Because the move is quite drastic, because C heavy molasses hardly has any alcohol left. So essentially, basically, if you ban sugar cane juice and B heavy, then effectively production will just collapse. Now, whether there'll be a rethink on this or not is something we need to see. But as of now, it's a tough space for investors to be in. So eventually there will be a rethink, and to that extent, the stronger sugar companies will come back, because otherwise many of the companies will go into deep losses. They will not be able to pay farmers, and then the entire equation for the government also goes for a toss. So it's wait and watch. Right now, I wouldn't recommend buying into this space at this stage.
What would you recommend one should do with the banks now? Just add more or stay invested if you're holding from old? Because that's one space where everybody's excited now, Sandeep.
Yeah, so banks, they consolidated for a long time. So I think the larger ones do offer value still among the entire market. So the overall market's become overbought, I think, after the sharp up move, what we've seen over the last 2 months. So finding value is becoming difficult now. But among the larger banks like ICICI, Axis, I still like them at these prices also. And we are starting to see participation from HDFC Bank, Kotak, etc. also, as FII flows have started to pick up, because they tend to be more of FII favorites.
Is there only one, looks like there's like this one trick pony for the markets, that FIs will come back, buy, and when they will come back, we will sell them higher. Everybody seems to be talking about this, Sandeep.
No, the story is about economic outlook and macroeconomic, the overall macroeconomic scenario. I think the economic outlook and macroeconomic scenario for India is very strong. I don't see any negative in that. So, per se, there's no big reason to sell aggressively in this market. But given the way the markets have moved up, it's tough to find value to buy. So, I think that's the space we are in right now. So, I would say it's a market where you buy on pullbacks rather than try to sell on rallies.
Okay, fair enough. Meantime, let's also map out some interesting data then. And there have been 3 stocks that have actually managed to beat the index consistently. And this is for 7 straight years on the trot. Any guesses? It's Trent, Varun Beverages and ESAB India. Let's understand a little bit more as to what has driven this outperformance. Got Samit here with the details. Samit?
Well, if you see, there are more than 4,700 listed stocks in India. Out of this, only 3 have managed to beat the Indian benchmark index, that is Nifty 50, right from 2017 till 2023 for the last 7 consecutive years. And that's Trent, Varun Beverages and ESAB. Now, these 3 stocks have given returns more than what Nifty 50 had given in the individual calendar years, that is from 2017 till 2023. When it comes to Trent, it is the fundamentals which have been growing much ahead of what the street was expecting, which has also led to an earnings upgrade cycle. Along with that, despite weak demand, the company has managed to outperform its peers. It has reported consistently a strong same-store sales growth and higher footprints, and also its Zudio store has been a success since its start back in FY17. If you see, Zudio has managed to reach around more than 350 stores, and its average productivity is more than 2 times that of the industry average. Now, apart from this, it is also a strong profitable company, that is Trent. Now, moving on to Varun Beverages. Now, Varun Beverages has not only expanded in India, but also on the international side also. It's one of the global largest global franchises of PepsiCo. And in India, if you see, the company has a presence in nearly 27 out of the 28 states and in 7 out of the 8 union territories in India. And apart from this, globally, it has presence in nearly 5 countries. Now, the company's energy drink string grown exponentially over the last 2 years, and the company has managed to increase its distribution footprint from 2 million back in 2018 to close to 3.5 million in 2023, and it has continuously logged a volume growth of nearly 15%. And lastly, when it comes to ESAB India, the company's revenue has grown at a CAGR of nearly 28% over the last 5 years. Margins, which were earlier in the band of around 8 to 10%, have expanded to nearly 19%. It has a strong balance sheet, which is nearly debt-free, and a strong parent company, which is an MNC, US-based MNC. And of late, if you see, the company has been continuously benefiting owing to the rise in construction activity that we are seeing in India, and also because of the more government focus towards infra and the rising infra spends. So these are the 3 companies that have consistently beat the Nifty in the last 7 years.
Sandeep, why is there so much of excitement in a Trent and a Titan? They both represent consumption. Consumption is not doing well. But Titan's market cap 3 lakh crore, Trent's market cap 1 lakh crore. These are 2 unique Tata companies which are now commanding P multiples as if they are the next AI companies.
It's all driven by exceptional performance, Nikunj. Like the way Trent has performed in the light of slowdown and the way they have consistently not only grown, you compare it with any retail company in India, like their performance is so exceptional, and I think that's what has driven the stock price higher. And when the company keeps on performing so well, there's no reason for existing investors to sell, new investors emerge, they are not raising equity, so that drives the stock price high. And same is with Titan. I think what's happening on the Tannish franchise is it's I think it's absolutely superb the way they've been able to deliver. So like even I had expected that they should be slowed down, but then they are capturing market share in such a manner that even in a market which has overall slowed down, they keep on doing well, and that drives the price earning ratio higher. So Trent, unfortunately, I have not participated in the entire creation journey, but then the numbers speak for themselves.
Are you confident of, see, when we say confident, it's all about probability scenario. I just want to bring this point out for, our viewers. I wish predicting the future was that easy, no one knows, but you work with probability. If the probability is more than 60-65%, then and valuations are strong, then it becomes an investment. That's a very basic thesis which long-term investors they follow. Look at probability and look at margin of safety. So Sandeep, where is that combination of margin of safety and probability that 3-4 years of earnings is strong?
I think there should be many companies which would happen, where this could happen. But I think if we see policy flip-flops, then some of these stories, which are relying on PLI for growth, etc., now there's suddenly sudden clawback. So I would say that we have to be careful about segments where the companies are purely relying on government policy or support for growth. That said, where there seems to be clear visibility is the defense space. I think the kind of order flows that are flowing on to especially the PSU defense companies and eventually to some of the private sector ones. So I think that's one space which will keep on buzzing. Valuations are a bit stretched, but I think they will remain stretched for some time. Then we have the entire, I think the infrastructure construction space still will continue to do well because that's one space where order flows will be strong. And there was an expectation as election uncertainty comes, what will happen out there. But the recent state elections seem to dissipate that thing. So I think we'll see some continued momentum out there. Then there are the emerging spaces related to renewable energy, etc. So I think that's where also there could be some opportunities.
Right, you've also got some stocks from the defense space that will be in the spotlight. Masgaon Dock has received an order worth about 1,100 odd crores from ONGC. Let's understand from you, Sandeep, as to how you're looking at the long-term potential for some of these defense names. Do you think that for select companies, perhaps the order book could be exhausted in the next few years? Is that a bit of a concern, given the steady run-up as well?
In fact, the order flows, as I've observed, are much higher than what they are able to execute. So I think the challenge will be on the execution cycle rather than on them getting orders at this stage. So I would think that order flow is not a concern for a majority of these companies.
Okay. Majgaon shipyard, Cochin shipyard, just been such a dream year. Now, Sandeep, we talk about government companies which have a play on defense, but which are the pure defense companies which have a play on defense?
In the private sector, the companies are relatively smaller. So I think there are some which are into doing work for a lot of these missile and related components and software that goes into them. There are some companies which are into simulation of various weapon systems, etc. But they are relatively smaller. Like they've grown from what they were 2-3 years back, but they are relatively smaller. So I think those are the only pure plays. Other than that, we have companies like Bharat Forge, Tata Motors, some other companies also doing work on defense, but for them, the overall order as a proportion, a flow of from defense as a proportion of the total sales is still small.
Okay, just going through some names here, and well, sugar was a big casualty last week. We did see some chop and churn in some of the NBFCs, and another big casualty last week was PTM. Sandeep, given that what PTM has indicated on the back of what they heard from what directive is from Reserve Bank of India, do you think it's a good time to buy this selling into PTM? Do you think markets have reacted far too much post their commentary?
On the other side, I think the markets are giving too much credit to the earnings growth of Paytm, which was coming largely from these commission incomes which they were earning out of these getting these loans, etc., sanctioned. And that is not a business for which you give a P. So I was actually very surprised how those analysts were so gung-ho. I think sustainable business model for Paytm is very limited, and they are facing challenges from all sides. So I would not be a buyer.
PTM?
Yeah, I think after such a kind of a sharp sell-off, Nikunj, we'll have to wait out for buying the dips because the stock tends to get into that inertia selling for a lot more weeks. So even after this 200 odd point sell-off for the stock price, I would still believe that there should be more room on the downside for the stock price. I think one should not be in a hurry to try and enter into the stock.
Nuresh, PTM, what would you do? Buy the decline? You think it's oversold now?
So this is a a stock which actually gave a breakdown now. Was expecting 750 to hold on. So once you get taken out a major support, it could take a long time to revive back. So if I have to go buy, then you want to buy it at very oversold level. So if it comes closer to 550 odd levels, that's a place you want to look at it as a buy. Otherwise, the stock can go sideways.
There were some interesting buzzers as well on the volume side on Friday's trading day. Kunal, just wanted to get in your take on some of these. Nazara Technologies, for example, or a 5-star. How are you looking at the charts?
So I think Nazara is something which I do track. The stock on Friday, I think, gave a price volume breakout as such, breaking past above the previous resistances of, I think, 785 to 800. Volumes were also at a multi-day high for Nazara. But then, when you look at this in the context of the last 3 months or 4 months swing high, the stock is nowhere close to the previous major swing highs of 900. So we'll have to need to see a follow through up move for a stock like Nazara to try and decipher that whether this is just a one-off move where the stock has tried to establish a base and now trying to consolidate at a higher levels, or whether it's getting ready for a breakout. 5-star, on the other hand, the stock on Friday gave a price volume breakdown as such because the volumes were at a multi-day, multi-week high, but the prices have come back into retesting the previous supports of 725, 730. So I think another 10 rupees, 15 rupees on the downside, and the stock closes below those levels, we could be looking at the stock going into a correction.
All right. Meantime, also keep an eye out on some of the auto stocks like Tata Motors, looking at increasing some prices of their commercial vehicles effective January by about 3%. Sandeep, where do you stand given the fact that it hasn't been all that enthusing when it comes to the festive demand for some of the auto majors? How are you looking at playing this space?
So I think demand has picked up, but it's not picked up to the extent what many of the companies were expecting. And to that extent, it could lead to a phase of consolidation. But overall, directionally, I think things should be good for both consumer durables as well as auto companies, because as inflation remains under control, as interest rates remain stable, we will definitely see a pickup going forward, and the input cost pressures are pretty muted. So overall, valuations are still not excessive and they are still in comfort zone. So I would still be positively inclined on the overall auto space.
But, Sandeep, I look at the data points. The data points are that there is a slowdown, right? Whether it is in demand, post-Diwali demand, stocking of FMCG, what the November dispatch numbers were there. I mean, Westlife is saying that they are struggling to sell burgers. Pizza Hut seems to be indicating the same thing. Jubilant again is going through slowdown. If there is a slowdown, do you think it's a matter of time it will hit everybody, especially in the discretionary space?
Many of the discretionary space stocks are as it is down. So now what we need to think of is that is this going to be a prolonged slowdown which will accelerate towards a bigger slowdown, or as things stabilize, we'll see a recovery? So I would be more optimistic rather than pessimistic. But many of these companies, as you also pointed out, are seeing slow growth, and to that extent, and many of them don't have also valuations which are cheap. So valuations are also not really cheap for many of these companies. So we need to time entry. So I would say that I would be a wait to buy investor in some of these companies rather than try to sell them for a 5-10% decline.
All right, thanks Sandeep for joining in today on the show and sharing with us your market outlook. Time to check in on the pre-open rates as well as get in some mid-cap ideas. Well, for the Sensex, the print of 70,000 is on right now. It's a 300-point bump up in the pre-open session. And for the Nifty, just about flat, 11 points lower. Let's find out what those mid-cap trading calls are. And Kunal, what's catching your eye today?
So Poonawalla FinCorp is something which I've been bullish on earlier from those 368 odd levels. It's now about that 400 mark, but it still looks very attractive at current levels. The volumes, the price movement have been quite powerful and strong for the stock price. So expecting a further up move, 440 as a target, and stop loss at 406.
All right, watch out for Poonawalla FinCorp. And Naresh, your top mid-cap call?
So that would be a buy on GSPL. The stock has given a breakout move yesterday with very good volumes. Now it's been a long time the stock has consolidated, and finally it looks like a breakout in play, a risk-reward trade here. I would expect a move towards 350 if this plays out. Stop loss at 288.
All right, I tell you what, we'll take a very short break right here on the show. Be right back for lots more.